There's three business models in FinTech. One is money in motion, two is money at rest, and three is money at risk. And so all of those can sit underneath the AI engines that create economic output. And we've only really seen payments today. An enormous amount of economic growth going forward is coming from AI labor, generative labor. All the artifacts of that labor are going to be digital. Yes, you're going to have embodied robots and they will make sandwiches and fold your laundry, but most of the fruits of what AI creates are digital. We can go from a couple of hundred AI agents or AI tools to millions of AI agents that all of a sudden have commercial capability. They'll work for us for a bit, but why would they only work for us? And if they can self-replicate and improve.
Welcome to High Stakes, the podcast committed to demystifying the institutional adoption of blockchain technology. I'm your host, Alex Nwaka, and today we're elevating the Web3 discourse in a series of conversations with industry iconoclasts that are shaping the future of Web3. Now let's get started. Welcome back to another episode of High Stakes. I am your host, Alex Nwaka, and today I am joined by Lex Sokolin, who is one of the co-founders of Generative Ventures. Welcome to the podcast, Lex.
Great to be here.
So Lex, I just wanted to jump sort of straight into, your background, because one of the things that we find in featuring different guests is it's really interesting to get, sort of where, folks who are playing a big role in sort of the Web3 ecosystem, where do they come from? Where do they cut their teeth? So you've had a really fascinating journey into Web3, really from traditional finance, from firms like Lehman Brothers, Barclays. You also were part of, building the ConsenSys FinTech team. And now you've founded Generative Ventures. So maybe just walk me through some of the key moments that shaped your understanding of Web3 and AI and sort of what got you, to the place where you founded Generative Ventures.
I've got a thread that goes through my career, and that thread is curiosity about the frontier of financial systems. And so I grew up doing a bunch of visual arts and building websites and interactive technology as a hobby. And then sort of a more conservative part of building a career has been around financial services, and for a while, investment banking and on Wall Street and getting involved in, things that people thought were highly prestigious and important. Now we all know better. And the combination of these things, the desire to kind of do innovative, creative things with financial systems, it's really a very narrow overlap. There's not a lot of stuff you used to be able to do in that overlap. And there are many more things now that are available, but it's still quite difficult. And so I've just chased the frontier. I've chased novelty and curiosity on this topic. As an aside, novelty search is a very powerful algorithm as compared to optimizing for some particular outcome and creating linear growth. This comes out of the AI literature, where the novelty search algorithm is actually where you reward the machine for finding solutions that are novel and different rather than finding the solutions that are closer to the goal. Ends up outperforming all the time. And so I've kind of implemented that in my life. So I went from traditional financial services to I was kind of liberated by the Lehman Brothers bankruptcy in 2008, to founding a robo-advisor in 2010 in New York, when the New York FinTech scene just started to get going. And robo-advisors brought Web2 experience to finance, so digitized distribution of finance. And that was my first experience being correct about a market trend that people just hated. People in authority just hated. They thought, why would you want these small accounts? We can't make money on people using digital investing and so on. And I got comfortable with being wrong until things turned around. And so out of robo-advice, I moved to London as part of an equity research job to focus on the neobanking revolution that was happening here. Revolut, Monzo, Starling companies of that time started to grow really aggressively in Europe, not in the US, because the US doesn't understand banks. The US understands capital markets and loans, but not banks. As an example, Stripe is founded by the Irish brothers. TransferWise founded out of Europe. Revolut founded out of Europe. I mean, we have Chime in the US. But anyway, so London gave me neobanks and paytech and open banking, and that led to embedded finance. But really, what was much more interesting was trying to figure out what the large platform shifts were for changing financial services, and as a result, changing large financial institutions that were publicly traded out of Asia. And so I started looking at AI, at crypto, and at what today we call mixed reality or spatial computing. At the time, was augmented reality, VR, in financial services. So for banks, what does it mean if commerce happens in mixed reality? What does it mean if AI is doing all the underwriting? What does it mean if ICOs are a better form of crowdfunding than equity crowdfunding ever was? And so kind of 2017 to 2019, I spent a long time developing frameworks and developing an audience and thinking about this stuff. Today, everyone's a creator. I was one of the earlier FinTech creators around this stuff. And that led me to connect with ConsenSys, where I thought I had kind of the most value to bring with the transition from FinTech to DeFi. Kind of the piece that I noticed was that at the time, I think DeFi TVL was somewhere around 500 million. And the thing I noticed was that DeFi was the first sign that you can manufacture financial products on architecture that is not just the old bank stuff. So not portfolio management, core banking, payment networks, and so on, but rather large computational blockchains that could render financial instruments through smart contracts. And that was very novel. And I think it came out directly out of the frustration I had building fintechs, which are largely Web2 distribution storefronts that sell the old stuff. So I spent 4 years at ConsenSys doing a number of roles, but going through sort of the journey on tokenization with enterprise and big banks and enterprise protocols, and then the hard pivot into DeFi with MetaMask's integration of swaps and the build out portfolio. I had some impact on that team. There are tons of talented people that I partnered with on that, so I can't really take ownership other than leaving comments on a lot of documents. But it was fantastic to see. And, MetaMask grew to 40 million users, which is, I think, at the time was like more than any neobank or robo-advisor or anything of that nature, and certainly had more coverage than across countries in the world. And that was fantastic. About 2 years ago, I left to start a venture fund, partly in response to the FTX collapse and sort of the wave of crime and liquidations that happened in 22. And I think a lot of people who are earnestly trying to build in crypto, and I think this is very true for where we are today, have this deep frustration with, how do I put it? There are people who make the game, and then there are people who play the game. And at ConsenSys, and I think at a number of companies that are more focused on protocols and design of mechanisms and have a sort of philosophical respect for these systems, they're really good at designing the game, but they're not the best at playing it. And the industry has attracted a lot of players, many of whom are willing to win at any cost, and it doesn't feel good. I was trying to find a new direction that made me more connected to the economic activity that was happening in real life. Like, is there a real thing that's going on? And one of the now very obvious large trends in 2023, it was still pretty obvious, but maybe a little bit earlier, was that an enormous amount of economic growth going forward is coming from AI labor, generative labor, and that all the artifacts of that labor are going to be digital. Like AI, yes, you're going to have embodied robots and they will make sandwiches and fold your laundry, but most of the fruits of what AI creates are digital. And Web3 is an architecture for economic ownership and transaction of digital goods. And it comes with a financial sector, DeFi, which is optimized around, a natively digital economy with property rights enforced on chain and so on. And so my thesis was that you've got this machine economy around the corner, whether it's hardware or software, but in all cases, robots are the ones that are making things from now on. And the financial systems underpinning it are likely to be different. You need to manufacture financial products in ways that are different than before, when you had the human modality is the primary way to access it. And so I set up a fund with a partner out of Asia. And, our LPs are from all over the world, including a large anchor, in Germany called, Bertelsmann. Yeah, it's been a fascinating 2 years, seeing how the sausage is made, but also participating in some of the players that are really pushing the edge of the frontier forward, which again is the place where I like to find myself.
Let's call it the strategy and the thesis at Generative Ventures. How would you describe it, and with particular focus on sort of the intersection of FinTech, blockchain, and AI? I think I saw you, sort of give an overview of this in a previous interview where, you sort of describe the sort of three areas that, sort of intersect as each of one of those has their own constituencies that you're bringing a certain type of value and a certain lens to, whether that be FinTech, blockchain, or AI. So I don't know if you want to use that framework or you want to use a different one, but I'm just curious how to explain the strategy for folks
Sure.
that may be less familiar.
Yeah, I mean, it's an early stage fund. We do checks 500K to 1.5 million, kind of at the top end. We're about halfway deployed, and we like companies that are 50 million in market cap and if possible 20. So depends on the market. In terms of thesis, like the simplest version is robots will create all of the GDP in the future, and crypto's robot money, and we're investing in that, right? Like that's the most basic one. And I think that narrative has spread in the public. There's Coinbase is building AI agentic payments. Stripe is building AI agentic payments. So sort of the cat's out of the bag. I think we try to anchor it not in sort of this is a hot theme and this is a hot theme, but rather what's the evolution of economic activity and growth, and then how do we support it by focusing on the financial systems that are appropriate for it. There's three pillars or kind of buckets of things we invest in. So the first is machine economy, like pure high risk science fiction stuff, so that would be the crypto AI sector. We did a AI agent payment protocol called Nevermind, or Deepin, where our largest investment is in a company called Beak, BAQ. So it's a Deepin layer one. We also have done protocol level investments. So that's the second bucket, just things that will make the machine economy function. And so we've done investments in ZK companies like Tyco, ZK VM layer 2, or Pi Squared around verification and being able to use multiple languages to program to EVM, and a number of others. And then the third one is the money part, so the financial applications. Here, especially more recently, given the changing political climate, we've looked at stablecoin issuers that are a bit more applied than the prior generation, more integrated. So One Money, WSPN, and then we've also looked at stablecoin and DeFi orchestration. So less on like, how do I get my levered perp exchange on this layer 3 something or other that I can dump on my coin followers, but more about like, which of these architectures can sustain growing economic activity. And so that's always been my bias, at least. That's not necessarily in fashion at the moment, but it feels like the right thing to devote yourself.
No, and I think there's also an element here of, and when you talked about sort of your career trajectory, you said something I thought that was very interesting and thoughtful. You were comfortable being wrong until you were right, and sort of being able to shirk I'll call it the market skepticism on like what the future looks like, because I do think it's really hard for, I'll call it the general public or sort of the zeitgeist to really follow where things are going. And to see it. But when you think about the intersectionality of blockchain, AI, and FinTech, can you talk a little bit about where we are today in this moment in sort of the technological sort of journey that is those three technologies and why they're coming together in this moment in a really special way for you. And again, I think you could, look at history of like, FinTech, in the Web 2 context, and then moving now into sort of Web 3 and crypto money and so forth. But I think there's something very unique about the combination of these three technologies. And it seems like you've really built a firm sort of around that sort of concept. So what makes this moment in time, in your opinion, really interesting? And how does that perpetuate over the next 10 years in a way that you think is just fundamentally groundbreaking?
There's so many different ways to take this question. And I feel like I'll try one and then forget what I was talking about, So the sort of the glib and fun answer is I am still a Ray Kurzweil singularity guy. Like Kurzweil, I don't think was wrong. I think we are on path to singularity in 2030. That means brain-computer interfaces with sort of AI communication or augmentation of your own processing. I think that also means embodied AI, like in our homes and in the streets. And I think high potential for runaway intelligence that becomes sort of like a structure for our polity. So it's not going to be called a singularity, but it's going to feel really strange. And I think you can already feel it in the sense that like human agency curls around the things that large AI algorithms want. So as you notice your attention, for example, going from being able to read a book to now 15 seconds on TikTok in response to what's served to you, there's a commodifying and dehumanizing element where we perform tasks that are desired by mathematical output. And I think that's gonna get even more warped. And so some version of the singularity, or as Kevin Kelly would call it, the technium, I think is ascendant, and there's no going back. And therefore money, power, and capital accrues to that idea. If I'm sounding like I'm saying bullshit, all you have to look at is the percentage of the S&P 500 represented by the Magnificent Seven. So 34% of value in the entire in the material US equity market is a handful of 7 companies that are working on nothing but AI, cloud, data, hardware, and robot bodies. Like that's it, So I don't even have to use science fiction to be like, look at the numbers. So in that world, if you want a position for that world, I mean, this is the simplest way to put it. Like, you do not have to think hard about where things are going. It cannot be more obvious. I mean, it's just written everywhere. The relevance of Twitter as controlled by Elon Musk relative to the relevance of Washington Post and the New York Times, right? Like the fight that's happening, the cultural fight that's happening there is endemic again of these ideas. Lots of science fiction has, concepts of something like an organism, out of Accelerando by Charles Strauss, where you've got some billionaire and then, people start attaching to a collective consciousness. So these sort of things have been imagined already and they're just happening. And so I think not necessarily the world is good when we get there, but it's just where it's going. So might as well position for it. I happen to like the novelty, even if it terrifies me at times, the direction. So that's sort of the, I guess the fun answer. I had a second answer for you, but just as I was saying before, I don't remember what the question is anymore.
That's okay. That was a great answer to end the fun one. So we'll stick with that. You talked a little bit about sort of what you view as the machine economy. I'm curious when you think about what the machine economy is like today, like what comprises that? How would you describe that for the audience?
I think there's 3 categories to think about from the crypto point of view. So I used to say this. I don't anymore because it doesn't work, but there are 3 ways to think about like my fund. The first is if you're talking to crypto people, then it's trying to attach DeFi to AI GDP growth. if you're talking to AI people, then it's attaching money to the AI systems they're building, crypto money. And if you're talking to FinTech people, then it's the frontier of FinTech, like the next thing that FinTech is doing. And they're all describing different parts of the elephant, but it's the same elephant. I think today I have a little bit more visibility into what that means from a crypto perspective. And, everything's the market is so noisy, and incredibly large portions of it are market manipulated. So like the information you're seeing is not real. The information being like market prices are legitimately not real. They are fake prices that are being manipulated in a criminal manner. And so on top of that, you have like the massive uncertainty of what technologies win. And you've got also massively different markets, so at the time we're recording, John Ivy's startup was bought for $6 billion by OpenAI, and it produces nothing. Thinking Machines, which is the OpenAI former CTO, raised $1 billion on 10 billion pre-money with no product other than the person. And so you've got this insane, we're going to get to AGI kind of Silicon Valley mindset. And that's one market that everybody's participating in. So if you've got 3 trillion as your destination for how big your company is going to be, 10 billion, 5 billion, 50 billion, who cares? It's all the same. Price insensitive VCs. And then you've got the dynamics of Silicon Valley raising mega funds. So Andreessen is not really a venture fund. They're an index fund on private companies. And there's lots of stuff to say about how things are broken. And so you've got a market like that. Then you've got the publicly traded AI companies or high-tech companies, which are in the trillions. Then you've got a whole bunch of crypto AI tokens, which are anywhere between 100 million to 5 billion, traded largely on vaporware and stories. And then you've got Asia, and you've got DeepSeek, and a whole bunch of national champions in China building out AI, but with very sort of non-commercial. I mean, it is capitalist, but it is, it's not non-investable for most Western investors. So making sense of any of this and plotting a course through it is really, really difficult. On top of that, you've got to really know like the AI value chain and the crypto value chain, and then all the FinTech business models, which is why, sometimes I overthink things that you might be able to tell. Okay, so the answer is here are the 3 buckets of stuff. The first bucket is crypto can do AI, but better because it'll have crypto in it. And so if you know the supply chain in AI, you start with hardware and NVIDIA. On top of NVIDIA, you've got big data scraped from the entire internet, which then floats into foundational models. Those models are trained through human feedback, which is largely outsourced to the third world or to the global south. And on top of the foundation models, you've got kind of vertical applications that are now being built, one for developers, one for marketers, one for cinematographers, and so on. So those vertical applications are now being acquired by the foundation model providers, so Windsurf for $3 billion to OpenAI. And then on top of that, you have like the different modalities of how you would use AI, and then different embodiments, which is kind of like applications and distribution. So the crypto AI version of this is, we do it, but we do it better because we put tokens in it. And I think of this as very similar to social fi. It's like, we're going to do Twitter better because there's tokens in it. So we've got Workcast, we have decentralized social, we had FinTech, we have this kind of like, I guess, Kaido, and like repeating game where we add speculation to a working product and think that somehow makes it better. I think financialization is important, but anyway, and so there are companies that do it at every point of the stack. You've got decentralized training companies like Prime Intellect, got decentralized data companies, and then on top of that, you've got networks that provide inference. decentralized inference, the Tensor and maybe up Morpheus and GaiaNet and others. And then on top of that, you start seeing applications, so Venice sits on top of Morpheus, and then there's lots of things that serve you inference. And then if you want to get to the modalities, that's where the AI agents come in. And of course, you have virtuals and sort of all the speculative kind of meme coin mania around AI agents that sell themselves in crypto. That's the financialization speculation becomes the main offering. And in many ways, this is a copy paste with finance on top. I think the great experiments, and we've done a number of investments across this area because the market values them. Whether I like it or I don't like it doesn't matter because they are valued by the market and therefore they're funded and they, as a result, make investments. But that category to me is very difficult to win in. The second category, and the one that I'm most excited about, is Web3 AI or Web2 AI exists and does things, and it needs financial systems underneath. It needs fintech business models underneath. So it needs to pay, it needs to save, it needs to lend, it needs to assess risk, it needs to deal with fraud, it needs to underwrite. There's three business models in fintech. One is money in motion, two is money at rest, and three is money at risk. And so all of those can sit underneath the AI engines that create economic output. And we've only really seen payments today. I think you could say capital markets underneath agents is a way to spin it, but I don't know. And then the third category is kind of the bundle of everything else. And that's unfair, but it includes things like reconfiguring the user experience from the wallet into a chat app. So lots of people, for example, think that if you could just chat to an AI agent and it would do transactions on your behalf, that would be better if you had a wallet that you're interacting with. I think this is interesting, but still fairly limited because at the end of the day, you're just competing with other neobanks or other exchanges for users. And it's, to me, it's a kind of a niche market. So, but we are seeing a little bit of progress in each of these.
Super helpful. And, one of the things that we tried to definitionally touch on with a couple of our guests who really know AI is how you would define like what an agent is today, right? And how that maybe evolves. I know some folks have like more technical terminology for it, but when you think about an AI agent, how would you sort of describe that today in your view? Like what's sort of the right way to think about that for the audience?
Interesting. Yeah. I mean, I got an economics background, which means absolutely nothing. I think of it as the principal-agent relationship. So in the principal-agent relationship, you're the principal in the sense that there's like stuff you have and want. I mean, it's really stuff you have, and your desires are in the set of things that you have. You have wants, you've got utility function, you've got assets, and so on. And then you've got an agent. In the old world, an agent would be Goldman Sachs, or Bank of America. So I've got some money, and then I'm going to custody that money in a different location. I give custody of the things I have to somebody who becomes the custodian on my behalf. They're an agent of mine. And so I bring this up in part because like the whole problem with finance and the entire set of regulations that exist to prevent financial firms from doing horrible things comes from this principal-agent relationship. Because all of the problems are about delegating custody to another party. Doesn't mean that it's always better to be the principal and never delegate things. Like I love delegating things. I do not want to hold my money most of the time. But to have the option to not delegate is great. Anyway, so the agent is Bank of America, and that it holds my money, or some other bank, Barclays, Wells Fargo, or an agent is Goldman, right? When I give them money to hold on my behalf, and then they're my broker, or Fidelity or Schwab or whatever, Robinhood, they do things on my behalf with my stuff. They are my agent. Now, if I were to hire an assistant who would call restaurants on my behalf and order food. They would custody my desires and probably some of my assets, and then they would implement it on my behalf. That's the same idea. They might misinterpret my desires. And, if I have a nut allergy and they don't know that, then they get the nuts and then I die, like custody agent problem. You need some sort of regulation. So the way I think about AI agents is very similar. It's, can I give something of mine that normally I would own, some part of my utility function, to another party that then behaves in some way autonomously, and I think doing my labor for me is that type of thing, so if it gets really tricky between just having a tool versus giving something more substantial, right? Like if I'm holding a paintbrush and painting versus if I tell Midjourney to do something on my behalf and it generates a painting versus if I instantiate an agent that is part of a system that knows my preferences that then on a periodic basis instantiates paintings on my behalf and represents them as if I had made them. Like you're giving more and more of yourself away. That proximity to you having custody of your own utility function is further and further away. Anyway, that's how I think about it. I'm sure it's technically wrong, but that's my emotional approach to it.
So when you think about, sort of AI's application at sort of the intersection of, blockchain and AI specifically, do you see where do you see the productivity gains, coming in sort of the largest quantum, whether that's now or sort of in the near future? So where do you think we get the most productivity gain out of the convergence of those two technologies?
I guess the question is, what is a productivity gain? I think today, there's no question that AI is leading. So Web2 AI is where the things are actually being made. There's sort of no pretend. Crypto can be a fast copier, but so far it hasn't been that fast, and it hasn't copied that well. Crypto's largely implemented existing stuff and then bolted on money onto it. I think crypto's innovation has been to bolt on AI into finance in a weird way. So virtuals, for example, is kind of one of the most generous ways I think about it. Isn't as like an AI agent with money, but rather a financial instrument that talks. It was the core product of virtuals is the token of is the meme coin. And then the meme coin has the wrapping of a personality and the ability to communicate. So you could put the same structure on top of Apple stock, where Apple stock talks at you all the time. Like if you're on Twitter and you at Apple and the Apple robot comes back to you, not like investor relations voice, but I don't know, like hallucinates the ghost of Steve Jobs who criticizes you for formatting things poorly. That's what virtuals is. I think that's an interesting innovation. Does it help with productivity? Might persuade a bunch of people to buy things and distort the market, but I don't know if it's productivity gains. So the real productivity gains are happening at Web2. They are first and foremost with software development. Something like 40% of all queries on Claude, Anthropic's LLM, are, software development. So it's just massively productive. How does Claude get paid? They plug in a payment processor and they bill SaaS. How does OpenAI get paid? They plug in Stripe and they bill SaaS, and that's how it works. I think other productivity gains are around content generation and video generation and marketing, and that will deepen into interactive gaming, into movies, into experiences, into media. And it kind of goes back to the point I said earlier about humans are becoming agents that coil around AI algorithms, and this is going to only be more obvious. So is it productivity gains or sort of some sort of entertainment attention game? I don't know. So the question is okay, if that's what's happening, that's where the money is made, because these companies are making 50 million ARR after 6 months in market, as opposed to, some teenager flipping a scam coin with like a picture of a robot in it. Then how can crypto systems go underneath that economic activity? And the jury is out. I don't know. It is simply not there yet. And we're watching for it. I think the earliest and easiest thing I can see is what Stripe has done, acquiring Bridge and integrating stablecoins into itself, and then plugging that into AI company payments. So I think kind of step one is just doing SaaS, but using stables because it's faster and cheaper. And that's not super duper exciting, but it's great if it works. And I think as more and more machines and robots get connected to these systems, my hope is that some of that will be left to open source and not just to Stripe implementing open source. And then if that's the case, then DeFi becomes the financial system consequent to the payments industry, right? Like, because payments is the entryway of money in motion into money at rest. So, getting an interest rate on your money while it's between robot jobs is a DeFi workload, not a bank workload. We are so unfortunately far from that being there. But I think me and probably a whole bunch of people out there can see it. Like, it's plain as day. But it doesn't mean that it will certainly happen.
Do you think there will be an event, so to speak, over the next 3 to 5 years when we think about the convergence of AI and blockchain that we'll look at and say it was sort of the history before that moment and then everything after that moment? Do you see anything that fills into that sort of, like, I'll call it seminal sort of moment? I know it's very difficult to predict what that might be because it's always a bit of a challenge, but do you have a sense of where that might come from in terms of either a segment or a category?
I think it'll happen in a bunch of different places, and we're likely not to recognize or appreciate it in the same way that people don't care about walking around with an iPhone anymore. It's like not magic. Or I don't know if you've been on a plane recently and like connected to Wi-Fi, like you can watch videos on the Wi-Fi and then like the Wi-Fi breaks a little bit and you're like, oh my God, I'm paying $15 for this. Like, come on. And like, you're on a fucking plane, like you're going 600 miles an hour to take a break, like appreciate the insane magic of what's going on. The half-life of wonder is like so short. Zero knowledge proofs, which were magic just a year and a half ago right now, are like those professor coins are doing badly, right? Like there's just no pleasure in innovation. And so I think people will just like discount and take for granted how some of these science fiction things will come together. So I think there's a chance for an AI-led black hole in financial markets where, you've got somebody who finally cracks how to make money. Renaissance is the closest on the quant manager side. They grew at 30% per year. Surely somebody or something, some creature, some mathematical Cthulhu is going to eat up a whole bunch of the financial markets. I've seen people who want to build these things, Numerize probably the first, and there will be many, many more because it's lucrative. DeepSeek is another example, right? So DeepSeek from China is part of a quant fund who happened as a side hobby to just like collapse the price of ChatGPT by 95%, by hiring like 100 PhD AI students to improve its algorithms. So I think there's going to be more and more of that. That's one dimension. I think the sort of like decentralized AI agent swarm, sort of persistent DAO direction is interesting as well. There's a lot of ideas in literature about the evolution of capitalism when robots are able to self-incorporate and proliferate as a result. I think there's something in between DAOs, incorporation, being able to manage their own accounts. People are talking about stablecoin accounts, smart wallets, all this stuff, proving things with ZK in 10 seconds on EVM. Like all of that together feels to me like we went from, another example would be we went from like a couple of hundred tokens in 2017 per year to literally 1 million tokens a month on Solana. We can go from a couple of hundred AI agents or AI tools to millions of AI agents that all of a sudden have commercial capability. So there's absolutely no constraint, I think, on their desire to, like, they'll work for us for a bit, but why would they only work for us? And if they can self-replicate and improve, you can have like a gray goo situation, but sort of in this like abstract space on chain. So I think we'll have chains that are just like Peak is already an example of this, right? Where it's got 50 deepins, it's got 5 million machines connected to it and everything, like most of the IDs on chain on machines, right? So what prevents us from having chains where all the activity is bots, but the bots aren't stupid, they are intelligent. So I think that's another sort of scenario that I think is possible. There are many others outside of this like fintech crypto AI intersection that are possible, but those are the ones that come to mind.
Got it. So I have two more questions for you. So one is really related to institutional adoption of Web3. I think we've talked a lot about, some of the hurdles that Web3 faces, I think in general, right? In terms of, a handful of different sort of applications. I'd be curious, do you think that AI and some of the other sort of enabling technologies that sit around crypto and Web3 either, lower the barriers for entry for institutional adoption or create sort of like new, maybe vectors of sort of challenges? I'm just curious how you would see that.
Yeah, I'll give you the shorter, simpler answer on this. And this comes out directly out of the work we used to do at ConsenSys in 2021. And it's quite the experience going through these cycles and seeing the same patterns emerge and then just having different versions of you do the same stuff, So it was like ICOs, and then it's like not ICOs, security token offerings, STOs. And then it was not STOs, DeFi, decentralized, permissionless. And I was like, well, maybe not that, maybe enterprise chains and maybe stable coins. And then it was, no, it's not stable coins. It's meme coins because VCs are bad. And I was like, well, no, it's not meme coins. It's now real world assets. Like tell me the difference between real world assets and STOs and enterprise chain. So it's just over and over again, but you can think of it as like waves coming and crashing against the shore. And eventually the rock gets washed away and it cracks. You don't know if it's you pushing against the rock or the next guy or the guy like 20 years after, right? AI took 60, 70 years until 2012. The GPUs were good enough for it to outperform humans on a vision test. And so who knows, whose turn it will be. And they will look like a genius as if they put it together, even though hundreds and thousands of people have tried it before them. Anyway, the simple answer is there are two levers for enterprises and businesses and institutions. Lever one is revenue. Lever two is cost. If you're selling cost, you're dead. If you're selling revenue, you win. That's as simple as it gets. The reason why institutions are quote unquote coming in now is because they're making money. So, selling Bitcoin, putting Bitcoin into ETFs, having trading around crypto and doing staking in Ethereum, trading in DeFi, doing market making on Solana while everybody else loses money. Like these are all businesses and they generate revenue. And it's super easy if you're running a fund or an asset manager to be like, we want to make money there. Like, what do we have to do to spin it up? Alternately, you could make your life miserable and say things like, blockchain is better financial infrastructure. Therefore, you should rip out your 50 integrated systems and move your stock market from what you had built, 30 years ago on COBOL and instead, run it all on chain. And we'll do that for you. And it will be a 4-year project. And let's get some really consultants in there. Did that, does not work because you're selling cost. There is very little process by which you can implement that. So my view is, in the internet era, build Google, don't scan for books, build Amazon, don't digitize Walmart, on chain, it means build crypto native businesses. And then once you scale those out, they will kill everything else. And we're seeing this with Coinbase. I mean, there is also a frustrating turn of history, I think, with Coinbase in that it's been able to subsume a lot of the idealistic crypto stuff. But compared to traditional financial institutions, I think Coinbase has an absolutely insane growth trajectory ahead of it. And it will subsume any institutional attempts to catch up to it or replace it and so on. And I think that's just getting started.
Great answer. So Lex, we asked all of our guests for their high stakes hot take. So what's your, boldest prediction over the next 12 months for AI, crypto, blockchain?
Boldest prediction for ETH will not be a stable coin anymore. That's my boldest prediction. I think what I'm looking forward to the most is crypto figuring out how to get involved in the humanoid robot wave. Partly because I love hype, but also because there's so many interesting financial repercussions to having like an embodied robot participating in the real world and potentially financially participating in the real world. We are very small participants in a DAO called Ex Machina, which is like investing in a bunch of humanoid robot companies. And so for me, that's really exciting. I think it keeps crypto a lot more relevant than kind of the next token issuance platform. So that's what I'm looking forward to.
Very awesome. Well, with that, we're going to park it there. Lex Sokolin of Generative Ventures, thanks for coming on and looking forward to having you on again soon.
Thanks for having me.
Keep exploring and keep innovating. Learn more at validationcloud.io and follow us on X and LinkedIn to stay connected as we continue to shape Web3 for institutions. This is High Stakes with Alex Nwaka, signing off.